Interest rates play a pivotal role in the global economy, influencing everything from personal finances to international trade. But how exactly do these rates work, and why do decisions made by the Federal Reserve, the central bank of the United States, send ripples across the globe? Let's break it down in a way that's simple, direct, and easy to understand. What are interest rates? At their core, interest rates are the cost of borrowing money. When you take out a loan, whether it's for a car, a house, or to start a business, you're charged an interest rate. This rate represents the additional amount you'll pay back to the lender over the life of the loan. Similarly, if you're saving money in a bank account, the interest rate determines how much your money will grow over time. Interest rates are not arbitrary. They're influenced by a range of factors, including the policies set by central banks like the Federal Reserve. The role of the Federal Reserve, often called the Fed, is the central bank of the United States. Its primary job is to manage the country's monetary policy, and one of its most powerful tools is setting the federal funds rate. This is the interest rate at which banks lend money to each other overnight. While this rate might seem far removed from everyday life, it's actually the anchor for many other interest rates across the economy. When the Fed adjusts the federal funds rate, it's trying to achieve two main goals: maximum employment and stable prices. By raising or lowering this rate, the Fed influences borrowing, spending, and investment behavior, which in turn affects economic growth and inflation. How changes in interest rates affect the US economy? When the Fed lowers interest rates, borrowing becomes cheaper. Businesses are more likely to take out loans to expand, and consumers are more likely to borrow for big-ticket items like homes and cars. Lower rates also make saving less attractive, encouraging spending and investment. All of this stimulates economic growth. On the flip side, when the Fed raises interest rates, borrowing becomes more expensive. Businesses may scale back expansion plans, and consumers might delay major purchases. Higher rates also encourage saving, as the returns on savings accounts and bonds become more attractive. These actions slow down economic growth, which can help rein in inflation. The global impact of Fed decisions: the United States is the world's largest economy, and the US dollar is the most widely used currency in international trade and finance. As a result, the Fed's decisions have far-reaching consequences. Here's how. 1. Exchange rates. When the Fed raises interest rates, the US dollar typically strengthens. Higher rates attract foreign investors seeking better returns on their investments, increasing demand for the dollar. A stronger dollar makes US exports more expensive and imports cheaper, affecting trade balances around the world. Conversely, when the Fed lowers rates, the dollar often weakens. This can boost US exports but may put pressure on other countries whose currencies are tied to or influenced by the dollar. 2. Global borrowing costs. Many countries and businesses borrow in US dollars. When the Fed raises rates, these loans become more expensive to service, particularly for developing nations. Higher borrowing costs constrain budgets and potentially lead to financial crises in vulnerable economies. 3. Capital flows. Higher US interest rates often lead to capital flowing out of emerging markets and into the US, where returns are perceived as safer and more attractive. This can destabilize economies that rely on foreign investment. 4. Commodity prices. Commodities like oil and gold are typically priced in US dollars. When the dollar strengthens due to higher interest rates, these commodities become more expensive in other currencies, potentially reducing demand and impacting global markets. The domino effect. The Fed's actions set off a chain reaction. For example, if the Fed raises rates, other central banks may feel pressure to do the same to prevent their currencies from depreciating too much against the dollar. This can lead to tighter financial conditions globally, slowing down growth in multiple countries. Let's take a real-world example. During periods of Fed rate hikes, countries with significant debt denominated in US dollars, such as Argentina or Turkey, often face severe economic challenges. Their borrowing costs soar, inflation spikes, and their currencies may lose value rapidly. In extreme cases, this can lead to recessions or financial crises. Why does the Fed raise or lower rates? The Fed's primary concern is the US economy, but its decisions inevitably have global implications. Here's why the Fed might act. To combat inflation, when prices are rising too quickly, the Fed raises rates to cool down the economy. To stimulate growth, During economic slowdowns or recessions, the Fed lowers rates to encourage borrowing and spending. To stabilize financial markets, in times of crisis, like the 2008 financial meltdown or the COVID-19 pandemic, the Fed may slash rates to near zero to support the economy. Challenges and criticisms: the Fed's decisions are not without controversy. Critics argue that raising rates too quickly can stifle growth and increase unemployment, while keeping rates too low for too long can create asset bubbles or exacerbate inequality. On a global level, the Fed's actions can be seen as unfairly prioritizing U.S. interests at the expense of other countries. For example, a rate hike might stabilize inflation in the U.S. but could trigger a debt crisis in an emerging market. Conclusion: interest rates are much more than just numbers set by a central bank. They are a powerful lever that affects nearly every aspect of the economy, from personal finances to international relations. The Federal Reserve's decisions on interest rates don't just shape the U.S. economy, they influence the entire world. Understanding how interest rates work and the role of the Fed can help you make smarter financial decisions, whether you're a consumer, investor, or business owner. It also underscores the interconnectedness of our global economy, where a single decision in Washington, D.C., can have profound effects from Buenos Aires to Beijing. So the next time you hear about the Fed raising or lowering rates, remember, it's not just about numbers on a chart, it's about real-world impacts that affect us all.